very close to everyone in that replied.
Absolutely, yes.
All right. So then I will start, and thank you very much. Thank you for everyone who joined. Good morning again from my side. I just want to apologize on behalf of Alex, our acting chairman, and as well that they are not able to join us this morning, but they did say that they're going to reserve the first Friday of every month, 8:30 to 9:30, in their diaries going forward. So again, welcome to everyone. And then just I want to just pause for a moment to pay tribute to Derek. We all know of his recent passing, and we discussed this in the Exco at quite extensively, that we believe that the vision of SAIFAA is more than just one person, but Derek need to be recognized for starting SAIFAA, and for that we really want to pay tribute to Derek Smorenberg today. And going forward from here with SAIFAA, we believe is to honor also his legacy in SAIFAA. So from the Exco side, and I do believe from everyone as members, we really want to honor Derek this morning. A couple of things. Vision 5000. To the best of our knowledge, there's about 5,000 independent financial advisors in South Africa. And we really want to ask our members this morning to assist us to unite everyone under the banner of SAIFAA, for the reason that there's no other organization that is solely focused on serving the interest of the independent financial advisor. That first and foremost is the vision of
Johann,
to unite everyone. And in that respect, we recently introduced with limited yes.
You've got a little bit of a delay there, I think.
Johann, I think turn your camera off.
Okay, turn off my camera. I'll turn off my camera. Okay, I've turned it off. Is that better now?
Yes, thank you.
So just if our members can assist us to just get everyone on board that that's in the industry. As associate members, associate members will receive our emails, and they will be included in surveys that we do. Other than that, the members. So that is really what we would like to request from our members this morning. And then a last announcement, and that is about replacement of our CEO. We, as Exco, we decided to defer that to 2022. In the meantime, I want to thank everyone on the Exco that are volunteering their services to the organization so that we can take this forward and continue with the vision that was started by Derek. So with that, I would like to hand over to Edward, that is going to introduce, sorry, I have to give them an opportunity just to talk about the process. Tim, if you want to just come in on that before Edward is going to do the introduction.
Not too sure what's going on with my mic this side today. I was just saying, just to echo Johann and your tribute to Derek. Most of us have had personal engagement with him, and he was a large motivation. And it's wonderful to see so many people joining this morning, and the support we've received through the online channels, and just the next steps of vision that the Exco have been putting together, the 5,000, SAIFAA 5,000, these breakfasts that are going to be happening regularly going forward. I think it's a great tribute to the commitment and value to a space where, first and foremost, independent financial advisors need community that stands up for them and gives them a voice. And so part of this journey involves a lot of technology, and we recognize that some people struggled a little bit with the registration process. So thank you to everyone who made it past the finish line to this morning. For our next breakfast, we are going to eliminate one of those points of registration. So there will only be a Zoom, well, the proposed idea. You don't have to give feedback now, but if you do have suggestions, the process today was go to the website and book. You'd be then sent a registration link, which you then had to click on to register through Zoom. Part of that was so that we could have record through the website of which members were attending and to manage that process. And part of it was to have a level of security so that we didn't have random people arriving at a meeting that we broadcast. So my feeling perhaps is that we eliminate the website sign-in journey, and we just have the Zoom registration step for our next meeting, which I think is December the 3rd. So if you've got any better ideas or can give me some feedback as to what your journey was like, it does mean you have to have a Zoom account. I had one person come back and say they weren't actually registered with Zoom. So they have now registered with Zoom, and that's the current journey for the meetings. Just to also make you aware of the different platforms of communication for SAIFAA. The first is obviously the website. The second is the newsletters and the emails that we send out, those email campaigns. And the third is the LinkedIn page. We've grown nicely. We've got about 160 odd IFAs connected to that page now. So as Johann was asking to please spread the word, please encourage your colleagues. The LinkedIn page is one of the best ways to do that. The other way is to get them to sign up for our newsletter, and you can chat to me directly to find out how to do that. But the LinkedIn page is a great way to build community. And for those of you who are familiar with what I do, you'll know that I help financial advisors communicate online. And LinkedIn is one of those key spaces. If you need any assistance with that, please do let us know. I think I've covered everything, Johann. With that, Edward, I hand over to you.
Thanks, Tim. Appreciate it. So a quick one, everyone. I'm just going to introduce Bernard for us, who's our keynote speaker. A little bit about Bernard. He is currently working for Coronation. He started in 2016 as an investment specialist. His primary responsibility is the distribution of Coronation funds to the retail investment market. Prior to joining Coronation, Bernard fulfilled numerous roles in the financial services industry, both with JP Morgan and PSG Asset Management. Bernard is extremely qualified. He's got his CFA and holds his MBA from the University of Pretoria Gordon's Institute of Business Science. So quite a hefty CV there, Bernard. So I think we're definitely in good hands this morning with you. So thank you so much for joining us, and we really appreciate your time, and I'll hand over to you.
Yeah, thanks a lot, Edward. Really appreciate the opportunity. Thanks for the kind introduction. Good morning, everyone. It's a massive pleasure to talk to you today, and I do really hope you find some value out of this session. And I just want to ask one or two things before I get started. Also, just want to say, a very big thank you to SAIFAA and, all the work that they do. As you will also know, is that Coronation is a truly independent asset manager with no ties to, distribution, administration, etc. Singularly focused on fund management. So I think, again, the relationships between the likes of yourself and a business such as Coronation, which is truly independent in the way we go about doing our business, the way our business is constructed, the ownership within the organization, etc. I think there's a very close alignment with interest. And I want to thank you for your interest as well as your ongoing support and also interest across our entire fund range. So thank you very much for that. Can I please just ask if you can all see my screen? I just want to see if I can put it into full screen mode. Tim, you can maybe just give me a sort of go ahead there.
Cool, I'm watching. You can see your screen is not quite in presentation mode yet. I think it's sending it maybe to a different screen. We're not seeing the presentation screen.
That might be. Is this better? Or are you getting this?
I'm still seeing it in your PowerPoint layout.
There we go.
The slide layouts. There you go. Got full screen. Lovely. That
There
looks good. Thanks, Bernard.
So I'll kick off, and hopefully, as I said, you guys will find some value out of the session today. I'm going to cover a fair amount of ground, but I won't spend too much time on these respective topics. I think as I go down my agenda, the sort of, you know, enduring nature of these elements should become stronger and quite clearer. As we all know, the macroeconomic environment is extremely fluid at this point in time, and expect, you know, the slides that I present to you today to change completely towards the next quarter. I think as we go into some of the key risks and also some of the longer term trends we are currently facing, we think that is something that investors need to apply their mind to and have a longer term sort of horizon when they consider some of these aspects. And then again, leading into the meat of my presentation would be making the case for South African equity, which we think today looks extremely attractive and should deliver very healthy returns for investors on a medium to longer term view. And I would like to make a case as to why we believe that is most likely a decent expectation to have amongst investors, advisors, as well as clients. So just very briefly, kicking off, I think if you look at the global economic environment, I think it is safe to say that global economic growth has peaked. Having said that, we are still seeing extraordinary support for global economies, and it is our expectation that the global economic recovery will still be strong right towards the end of this year and well into next year, if not 2023. We do think, yes, it slows down from here. As I've mentioned, we've reached that peak economic output level. I think what is important to consider, however, is that the current economic output delivered globally is still above long-term trend expected average growth rate. So for the next year or two, even 2.5 to 3 years, we do expect a fairly robust and resilient global economic backdrop in support of economies as well as markets. Having said that, as I've mentioned, economic growth has started to slow, and I think we're currently living in a fairly low visibility world when it comes to economic growth expectations and assumptions. And that is predominantly driven by a massive discrepancy in vaccination rates. We are seeing resurgences in COVID cases in certain areas of the world, and also informed by the fact that many governments have adopted a zero COVID policy or stance, with China being a very strong case in point. And then, of course, you know, a further contributor that's currently leading to the slowing of the global economic output and environment is the supply shortages, which is obviously curtailing manufacturing, production, and everything, you know, from goods, services, etc. So I think a fairly robust and conducive economic backdrop, but do expect it to slow somewhat, but still should be fairly strong and resilient heading into next year. I think a key point to make on that point. When we look at, you know, some of the other elements that have started to surface and where a lot of debate is currently prevailing would be around inflation. We've done a ton of work in this space. I do want to make the point that it's still currently, we find ourselves in what I would deem to be sort of, you know, peak uncertainty, quite frankly. A lot of clever people on both sides of the argument currently making for the case that inflation is perhaps, you know, transitory. Many others, you know, making the case that inflation might be more enduring. Our view is currently that there is a strong likelihood that inflation is persistently higher than what market participants are currently pricing for, as well as what reserve banks are currently signaling to the market. So the risk of inflation and those pressures that are currently building up in the system is something to think about carefully, to monitor and to watch. Having said that, no strong view around where this might or might not play out. A very complex dynamic and situation to consider. It will be, however, important to see what happens with wage growth and also wages in terms of, getting people back into the workforce and where that settles. And a massive driver of future expectations, future inflation is the expectation that customers, consumers, businesses have around future inflation. So as inflation expectations perhaps manifest, they could as well become self-fulfilling and become more enduring over time as well. But definitely, the talk of the town currently in the global economic environment. Again, I think, in support of a fairly, decent economic recovery and a fairly resilient economic recovery, is that it is our key sort of, base case at this point in time that policymakers will keep, monetary as well as fiscal policy very accommodative. The risk governments currently run is actually, allowing for too much stimulus. We've seen the first signs. Many countries this year have started to increase interest rates. South Africa has not yet done so, but that is starting to happen. We've heard from the Federal Reserve Committee in this week where they are starting to taper back their bond buying process. But then when one looks across to the Europe, etc., as well as the UK, their stimulus, both monetary and fiscal, is still in full swing. And the buildup of debt in the system is a risk that I will speak to later, as well as the risk of making inflation more enduring on the back of this very stimulatory, macroeconomic backdrop from a fiscal and monetary stimulus point of view. So a couple of things to monitor in that space, but we do think governments will take their time and buy their time to make sure both employment rates as well as economic growth is on a strong and solid footing before turning off the proverbial taps, if I can call it that way. Another massive concern for us is, of course, the fact that, debt is built up in the system. And what we are finding currently is that governments are running massive deficits. This does, again, introduce problems perhaps longer term down the line. And I think, what a lot of people might argue in order to combat inflation is to expect a massive increase in global interest rates. Given debt loads out there, given the sort of, financial position which most sovereigns find themselves in, we think, extremely aggressive rate hikes for the time being is most likely off the table because, quite frankly, most governments out there will find themselves in a financial crunch or perhaps even a debt trap should rates move significantly from here and in turn obviously cause them to pay much more on their funding or borrowing costs. Moving over to the east, I think, what we have witnessed out of China of late is of course unsettling, to use a sort of, mild term to describe that, driven by a number of things. I think firstly, clearly a more intrusive state from a regulatory point of view. Secondly, an energy shortage in China, which is clearly curtailing economic output for the time being. And then I think also quite importantly, the sort of the uncertainty currently developing in their property development sector with the likes of Evergrande, etc., perhaps, causing a slowdown again in broader economic activity. What I will mention, however, is that a lot of the current slowdowns that we are seeing in China is self-inflicted. It is their decision to implement regulations. Government and the Communist Party directly targeted property development in order to deflate the property market and to prevent property speculation. And then thirdly, the energy crisis that China currently finds itself in is clearly a result of them trying to manage greenhouse gas emissions or basically, to get to their goals of carbon neutrality, as well as the fact that they've effectively banned Australian coal imports. So a lot of these things self-inflicted. That is somewhat unsettling over the short term. Market participants typically tend to be short-term orientated when they look at these things. What I would like to leave with you is some perspective. And the perspective here is that China is still the second biggest economy in the world, expected to grow at phenomenal rates, especially given the sheer size of that economy, and with a massive middle class, which is bound to grow for many years to come. So it still remains a very important economy. It still remains a robust economy. And please don't get sidetracked by too much short-term noise around the current slowdown within that environment. As long-term investors and as people taking long-term views, we still think there are excellent opportunities in selective opportunities within China, notwithstanding some of this clear shorter term risks that we are facing. We spoke earlier, and there were a couple of questions about the election. I'm not going to speak about the election in South Africa. I think, my 2 cents on that is that I think we are entering a very uncertain political regime within South Africa. I think coalitions and, coalition talks is basically going to be the sort of, the par for the course for the foreseeable future. It does create a lot of uncertainty as we head into 2024, when national elections take place again. The big risks we run from this, ANC losing a lot of power is the fact that service delivery can even falter further. Infrastructure can crumble further on the back of, call it, inertia, when people can't come to see eye to eye due to what I think will be very difficult coalition talks. So very uncertain from a political point of view when it comes to South Africa. On the positive side, I think the economic recovery has even surprised us. Even the contraction of 2020 was less than what we initially expected. Initially, we feared the economy might contract by 10%. The official number only came in at about 6.4%. The recovery that we have seen, yes, somewhat curtailed by the looting and the rioting we saw in KZN and Gauteng, a tragic event, and I think, defining a component of our future for years to come, as well as the recent sort of, load shedding that has resurfaced again. Notwithstanding that, we think, 4 to 5% GDP output is certainly achievable in 2021, with growth tapering off, however, unfortunately, into 2022. We currently expect 2022 to deliver growth rates of about 2.3%. So unfortunately, this recovery that we are enjoying won't be everlasting. And for growth to taper down to sub 2% in around 2023. So we have been supported by an initial strong recovery. However, that is not enough. We all know that to get us out of, the biggest, crises that we face, we need economic growth. And for that, those structural reforms, which we all talk about, which we all hear about, which has all been explained to government as to how they can overcome some of those remain absolutely critical in developing sustained long-term economic growth. As a matter of fact, at this point in time, given what we are seeing, we are still very reserved in our expectations for long-term economic growth to be anything significantly above 2 to 2.5% in South Africa. And unfortunately, that is not what we need in order to alleviate us from most of the pressures that are building in the system. 3.5 to 4% would be what we would think an absolute minimum in order to address some of our concerns, with the biggest concern currently being the fiscus. We all know that we have been bestowed with a very sort of, decent commodity windfall that has gone a long way in sort of, managing our debt load and also for our fiscal arithmetic, especially looking at the potential likelihood of government defaulting, restructuring, etc., their debt. That is a risk that is in the system. We do, however, think, given a sort of, fairly decent outcome last year from a growth point of view, a fairly robust recovery this year, and the fact that the tax take this year will be significantly higher than what was budgeted for, and also expecting a tax revenue overrun in the next fiscal year, we do think the risks of a debt default, a debt restructure has diminished significantly on a 5-year view. On a 10-year view, we are certainly not out of the woods yet. And that is where public sector wage bill, as well as, other structural reforms will remain absolutely critical in order to curtail that expense bill that the government will need to manage very, very carefully on a forward-looking basis. Of course, things like a basic income grant is a net negative for this current dynamic which we face. Consumers in South Africa, we are very surprised by the robustness of corporate results. We are very surprised by the fact that it seems as though people are spending money. If we look at mobility data, if we look at these soft indicators of credit card use, etc., it does seem to us that consumers find themselves in decent health. However, we just don't know how to sort of stack that up with the fact that about 50% of our population don't have jobs and are certainly reliant on government for support in order to get them through the month, so to speak. So quite concerned about latent effect as well on the consumer And then, of course, given recent fuel price increases, electricity price increases, as well as, grocery price increases. The average basket size of goods have increased by 10% or so just over the course of the last year. So the inflation number that we are seeing is not necessarily representative of the lower LSM groups as well as the higher LSM groups. It's typically the middle LSM groups that find that sort of 4.5% to 5% official inflation rate much closer to their official rate. It is the low LSM 1 to 3 and the sort of 7 to 10 LSM where inflation rates are typically skewed and typically much higher than the stated one. I think importantly, from a positive perspective, and I alluded to this briefly, is the massive commodity windfall, which we've enjoyed on the back of strong commodity prices. And of course, our miners paying bucket loads in tax at this point in time. That has led to a positive trade balance that is reducing somewhat due to the fact that fuel imports are rising at a rapid rate, given where the rand has moved to over the last month or so, and also, of course, given what has happened to oil prices. But we do still expect the current account surplus to remain in place for this year. And we even expect at this point in time a second consecutive current account surplus for calendar year 2022. We have already seen the biggest current account surplus since the early 2000s. I think the last significant one which we ran was 2001, and that has provided some support for the currency and will continue to do so as we expect further surpluses from a current account perspective into 2022 as well. I've mentioned inflation. We do think the official inflation rate will remain well behaved. I think the South African Reserve Bank has also built up significant credibility, not only as an independent institution, but also as an institution that has managed, inflation expectations in a very credible manner. As a result of that, we think inflation averages comfortably within 4.5% to 5% over the course of the next 2 to 3 years, and that might take some pressure off the SAIFAA to hike rates. I think what we've seen and witnessed across the globe so far is a combination of fairly aggressive to muted interest rate hikes, but the trend is certainly upward. Our expectation at this point in time, in order for the government to manage the growth profile, the economic recovery, whilst not facing immediate pressures from an inflationary point of view, we think our expectation at this point in time is an interest rate increase of about 200 basis points cumulative over the next 2 years. We think 25 basis points in November this year. We think a cumulative 75 during next year and a cumulative 1% during 2023, taking the repo rate to about 5.5% 2 or so years out. What the market is currently pricing in a 300 basis points rate in hikes, and that is informed about where global inflation is and also informed about where global monetary policy is either signaling towards or heading towards as well. But we still think the government will be fairly reluctant and incremental in the interest rate increases. Just a reference chart, just to give an idea, our current account surplus in yellow there, currently in firm positive territory, the first time in about 20 years, which we've actually ran a current account surplus. So expect some support for the currency due to this dynamic for the foreseeable future. And as I've mentioned, our expectation for 2022 is to run a second consecutive current account surplus. Yes, it will come down, but we're still looking at about 1% or so of GDP in terms of current account surplus. Moving on from there, I think, as I've mentioned, whatever we've discussed now, very fluid, very, I think, low visibility in terms of making strong predictions and assumptions. The world is changing very fast. Some of the longer term things that we ponder about, that we consider, and which we think all investors or financial advisors should at least give some thought at this point in time of the cycle. A lot has played out, not only over the course of the last 18 years, but also, of course, over the course of the last 15 years or so, starting with the GFC. And what we've seen and witnessed is governments throwing money at any particular problem. In 2007, 2008, it was to bail out the banking sector in the GFC. And today it was the bailout of society on the back of the COVID pandemic. The World Bank estimates that there's about 5% of global GDP was allocated towards support measures in order to support companies, consumers, and even governments themselves. At some point in time, that money needs to be repaid. And it is very unclear at this point in time how that is going to be achieved. So the build-up of debt in the system is something that is concerning us quite significantly. We all know that most governments globally will find themselves in an unsustainable financial position should interest rates rise dramatically. That explains the extent of the situation which we find ourselves. It is not only governments that are deeply indebted. We all know that corporates have used this extraordinary liquidity environment to beef up their debt issuances, and also, of course, on the back of that, to take advantage of the ultra low interest rate environment which we've seen. Not only public companies, and that is listed assets, have taken up this opportunity. What we are witnessing currently playing out in markets is that even private companies, so businesses not listed on exchanges, are issuing records amounts of debt or effectively bonds, recapitalizing their businesses and taking advantage of this very, very accommodative macroeconomic and monetary backdrop. At some point in time, there is the risk that all this debt spills over into systemic risks in the broader financial system, which will obviously be fairly dreadful for equity and bond markets. There are ways to hedge against this. The first one is not to own any longer dated government bond out there, especially in the developed world. And at Coronation today, we don't have a single cent of your client portfolios or your client assets invested in longer dated developed market sovereign bonds, because we just feel the risk is high, the return that you get is extremely low, and that just doesn't make sense to us on a from a payoff profile point of view. The other way to hedge against this is to incorporate diversifying assets into your portfolio, something like gold. For the first time in 15 years, Coronation has started buying gold equities in our client portfolios as well. Very similar ways of hedging against the second risk on this screen, which would be global inflation. I've touched on this, and I've spent quite a bit of time speaking about the complexity of this dynamic, as well as what our current thoughts are. Obviously driven by this monetary and fiscal support, which I've alluded to, wage pressures, and very tight labor markets currently playing out globally, and then of course this massive disruption in supply chain. One can add a couple of other dynamics to that. Perhaps we've seen peak globalization, we've seen people investing more in working capital, all sorts of things that could make the case for inflation on the longer term view. Last year, April 2020, in our first investor communication to our clients on the back of the COVID fallout, we flagged this inflationary risk. Today, everyone is talking about it. Again, what asset class would be in the eye of the storm? Certainly longer dated, high duration government bonds, as well as long duration interest rate sensitive equities, if I can call that. So thinking about the portfolio construction in order to hedge against this potential risk is extremely important. And again, not owning government bonds, allocating to equities that have some form of pricing power, commodities, resources, all metals and minerals and materials that have a millennia-old history of combating the eroding effects of inflation, I think has a role to play in a well-diversified multi-asset class portfolio on a forward-looking basis. Assets such as real estate, infrastructure, which can pass over inflationary pressures to their consumers, their tenants, etc., I think will play a much more important role in client portfolios in the years and decades to come. We all know that from a South African point of view, our social fabric is running extremely thin. And I think what was very, a tragic reminder was the looting and insurrection spree, which we saw towards July of this year. At this point in time, given our low growth rates, given our unemployment dynamics, and given the fact that, such a big component of our population live below the poverty line, that is unsustainable. And no one in this audience and no one in this country can say that we've seen the last of this looting, insurrection, etc. What this does obviously introduce is a lot of risk from a political point of view, as well as from a policy setting point of view. How does government address this? How do they think about redistributing wealth within the overall economy? So we do think it is going to be an interesting time from a political point of view in South Africa. Quite frankly, as the most unequal world in the world, it strikes me that populist parties in South Africa hasn't actually achieved bigger support than what they've had. Again, today, the EFF is coming in with about 10 or 11% of the votes. I think at some point in time, populist politics do take off should these concerns not be addressed from a South African point of view. And then another massive risk, just, focusing on the East somewhat again, is of course China. We've done a ton of work on China. We obviously are unsettled by, the authoritarian state being more intrusive in that economy. However, having said that, one can also argue that these things that are intentionally inflicted on the economy might even be well thought out and might even mean a more robust, a more equal long-term, economic growth profile from a Chinese point of view. But no one can profess to know or to know what the Chinese government will do next. So certainly a risk to watch and something to monitor closely. We're spending an inordinate amount of our time on understanding the current framework within China. Addressing this risk is through stock picks, which we actually think are beneficiaries of the regulatory announcements, which have been rolled out of late. We can also manage that allocation and exposure through adequate position sizing. So again, thinking about these risks and certainly incorporating it in our client portfolio. So just a reference chart speaking to inflation, and we all know that 1945 to 1980 was, peak inflation globally and a very, very poor time for investors. This just illustrates what rising interest rates as well as, inflation can do to the real value of bondholders. This is just a depiction of numerous jurisdictions. And as you can see, anything between 85 to about 30% of your real purchasing power being eroded due to something like inflation. Therefore, we don't own any developed market sovereign bond in our client portfolios today, given our risks that we see on the inflationary front, as well as the likelihood of seeing increases in interest rates, which we've already witnessed so far this year. A couple of long-term trends to take note of, and I think, something where a lot of thought needs to be given. We are spending an inordinate amount of time to try and position our portfolios for the long-term future. The first one would be decarbonization. We all know that is the buzzword currently, climate control, climate change, greenhouse gas emissions. We currently have got the COP26, call it symposium, seminar going on, where governments, corporates, etc., are making all sorts of promises, around achieving energy neutrality, achieving targets, and very ambitious targets, I would say. At the end of the day, what this means is that there will certainly be a massive shift in energy demand in the years ahead. So fossil fuels are certainly a no-go. That doesn't mean that over the medium to longer term, it couldn't make for attractive investment. But we can also try and, conclude what metals, what mixes of energy might be massive beneficiaries for decades to come. And in the forefront of that would be inputs into alternative energy sources, as an example, wind, solar, as well as batteries. And that is where copper, cobalt, nickel, lithium, zinc, etc., still has a very, very, very long runway. Businesses such as Glencore, Anglo American, very well positioned to take advantage of this massive long-term trend that we're seeing playing out here, and the reason behind the very healthy commodity exposure which we still have in our portfolios today. One cannot decarbonize the world without using commodity inputs, as I've explained just now, and those metals which I've alluded to are going to be instrumental in creating what we think is going to be a new form of energy developing in the years and decades ahead. A lot has been spoken about tech, and of course, how strong and how healthy the returns have been within the tech industry in the United States. And in many of those cases, those results are correct and are actually sound. Because what we are witnessing is a massive divergence between businesses that are using technology to their advantage, and especially, again, then driven and accelerated by this whole COVID crisis, which we've all just lived through. So the adoption of technology is extrapolating at an exponential rate. And there's going to be a line in the sand being drawn between those businesses and countries that cannot embrace digital technology. Most of our conversations we're having with management teams at Coronation today is how are you embracing technology in your business in order to strengthen the competitive position around your organization. And that is data intel, that is sort of, fine sort of, work around what products to push to customers, how to have bespoke offerings to different customers, etc. So certainly an area as well where a lot of money will be spent in the future, and it's going to be very important to identify those winners as opposed to the losers who are not able to pivot their organization in an environment which is more digitally driven. Another massive, after effect of COVID is increasing inequality globally. Again, this creates massive uncertainty when it comes to political regimes and also policy setting from governments, etc. We do think one needs to expect some sort of wealth transfers. We do think tax rates globally will have to go up not only to bail governments out of their debt crises, but also, of course, to redistribute wealth more closely. What impact does that have on corporate earnings, business, profitability, etc.? So again, an area where we need to monitor and watch the political developments unfolding globally very, very closely. And we all know that COVID will change the world profoundly. And we are seeing that playing out across all countries, all sectors, and all companies which we analyze, from sectors such as real estate, sectors such as, retail at this point in time, with e-commerce, making a massive inroads. The sort of long runway for things like online education or edtech, etc. There are a lot of traditional business models that will be unsettled due to how COVID has changed the world. And even governments will be impacted due to what has been a buildup of debt and then, of course, the emergence out of this crisis going forward. So again, I have to think very carefully about how this impacts future investment opportunities, and also be able to change your mind when facts do change in a rapidly changing environment. Are there any questions before I move on to the next section?
Bernard, I have asked people to post some questions in the comments, and nothing's come up there as yet. So I'm assuming people are still all following what you're saying and happy with that.
Brilliant. That maybe took a bit longer than what I expected, but I wanted to do that section justice, because I think there's quite a lot to digest and quite a lot to think of and to also ponder.
Absolutely,
at this point in time. So just moving on, and just sort of brief market overview, if you like. And I mean, these numbers are all to the end of September, but I think it just provides some important perspective in terms of what has played out. But given that what has played out, what might play out in the sort of, long, medium to longer term future. We all know that, from a return perspective, the last decade has all been about global equities and predominantly US equities. And I've highlighted those strong return numbers for you in that page, where, we all know South African assets have underperformed meaningfully. The fact that global assets have outperformed SA assets, and I'm talking equities here, by such a quantum over the last decade, does make us quite concerned about what global equities that will deliver on a prospective view. We've already seen South Africa outperforming global equities over the last 1 year period. And as a matter of fact, we would not be surprised to see South African equities outperforming global developed market equities for the next 5 to 10 years, given what we've seen from a relative valuation point of view. What we are also obviously all banking on when we invest offshore is this continual depreciation of the currency. Even over the last 10 years, that annual depreciation rate was about 6%. We think that is high, quite frankly. You have to bear in mind that incorporates the entire Zuma presidency, effectively, and also a strong case to be made for lower inflation differentials going forward. As a matter of fact, inflation in the developed world today is even higher than in South Africa. So we would expect a 3 to 4% annualized currency devaluation on a forward-looking basis. And to put some further numbers to these that I have on the screen, we think low to mid-single-digit dollar numbers from global developed equities would be a very, very fair and decent outcome. So you add 3 to 4% currency depreciation to low to mid-single-digit dollar returns on a 5 to 10-year view, and one will do very well to get to double-digit returns out of global equities. So the key message here is some expectation management in our view, where we think, you know, managing expectations, tempering expectations on offshore, and managing expectations up from a South African equity point of view, and also managing expectations when one think about the currency on a longer term view. I've already touched on the current account, which will provide some support over the short term. We have to acknowledge that the currency is already fairly weak, and we think, you know, a 3 to 4% annualized currency devaluation from current levels is certainly our base case at that point in time. We do know that won't happen in a straight line. So please manage some. Yes.
It's Tim here. Can we just jump back to the previous slide? Evelyn had a question. She was just asking about the 1 year growth, whether that is not distorted by the severe drop due to COVID.
Yeah, that is distorted somewhat by that. Obviously, the offshore markets are also distorted by that drop. They recovered sooner initially, but you know, what you'll see later on is that even the 3 and 5 year numbers now are becoming respectable very quickly. So yes, of course it is distorted, but that is again the point here. You know, we're coming off an extremely low base from a South African point of view. Before COVID, our market was sort of in a sideways grind for, you know, the last 5 years at least. And this chart makes that point further. And I think this is a very important chart to consider when thinking about the current structure of the South African stock market. This shows the number or percentage of stocks that have actually outperformed the JSE over the last 3 and 5 year periods. So effectively what this means is that more than 70% of all the stocks listed on the JSE has underperformed whatever the JSE has delivered you. So if the JSE has delivered you 5% for the last 5 years, 70% of stocks have given you less. This is as low as what it gets. Okay, even in 2008, 2009, you know, more than 50% of stocks actually outperformed the JSE. So we've had an extremely narrow market driven by a handful of winners and a massive selection of businesses being left behind. This chart makes that point somewhat, takes that point somewhat further, where the blue line at the top, annualized returns of about 18%, just from Naspers process and the miners alone, with the rest of the market giving you a minus 1.6% annualized for the last 4 years. The market as a whole gave you 5-odd%, but obviously buoyed and supported by the blue line at the top, which is clearly only Naspers and the miners. So a massive sort of, you know, lag in the rest of the market and a massive discrepancy between the winners and the losers. This is a market environment which is very conducive for active management, and it is a market environment not only conducive for strong returns, but also for very strong alpha on a forward-looking basis. So jumping into, because that gives you some context in terms of where we find ourselves today. So jumping in sort of, you know, into the core message of my presentation is trying to make the case for SA equity, which is currently the much maligned asset class in South Africa today. Our views are clearly, you know, in stark contrast with what we are seeing in the industry, amongst investors, amongst financial advisors, and sentiment in general. And having said that, I think this quote on the screen from Mark Twain has some relevance to all of us. Whenever you find yourself on the side of the majority, it's time to pause and reflect. And I do have sympathy with the fact that we've had 4 to 5, you know, morale-sapping years. I mean, I almost want to call it sort of wrist-slitting. You know, we've had bad news upon bad news upon bad news, which then in turn manifested into very, very benign return outcomes from an investor point of view. We were underweight South African equities in our client portfolios for the better part of the last decade. For the last 2 years or so, we've moved into a sort of neutral position, and today we are strongly overweight South African equities in our client portfolios on the back of what we deem to be excellent value as well as excellent stock picking opportunities in the market today. So for those of you that still disagree, where your clients disagree, I would like to make 5 points as to why we think SA equities are very attractive and why we think it warrants a big inclusion in client portfolios today on a forward-looking basis. The first point that I would make is that SA equities are cheap. We've been managing equities in Coronation for more than 8 years, and the overwhelming feedback that I'm getting from our investment team of 70 professionals who cover stock markets, both developed, global, and emerging on a daily basis, is that the JSE is extremely cheap. We run a number of hedge funds within Coronation as well, and I can tell you now our buy lists are significantly longer than our short list. And quite frankly, we need to think very carefully about those businesses that we are looking to short because they're already quite cheap. We are all obviously have been victim to the bad news and, media rhetoric and, sentiment which we've witnessed. But you have to remind yourself that bad news typically translates into lower prices. That has happened. And lower prices, not always, but often, is, one of the strongest predictors of future returns. And that is a very important point to make. Further, when we look at the South African market, we see none of the exuberance that's currently playing out globally. Whether you've seen this massive IPO burst, where you've seen, SPACs, shell companies, ghost companies being, listed left, right, and center. The exuberance you're seeing in areas such as electric vehicles, you're seeing none of that on the JSE. And I think that is an important point to make in an environment where market participants are willing to pay any price for any asset. Just in this week, Avis, the car rental company, their share price went up by over 200% in one day just because they announced that they are going to start buying electric vehicles in their fleet. Please explain to me what that does really, from an economic competitive position to justify the share moving up 200%. In fact, in South Africa, what we've seen is a massive sort of, delisting trend and effectively buyout trend from the JSE over the past couple of years. In calendar years 2019 and 2020, you saw 16 buyouts from JSE listed companies, with many more announced just this year alone. Heineken's bid to take over the Stel, DP World from Dubai bidding to take out Imperial, Standard Bank taking out the minority shareholders in Liberty. AVI has, we think, have had an offer for one of its businesses from an offshore consortium. Omnia's biochemical fertilizing business being subject to a bid offer at this point in time, and the list goes on. Now, whenever companies, buy other companies off the market, whenever there's sort of, these M&A activities, all sorts of reasons are given. And the press will write, a myriad of stories because good stories sell. However, there's only always one reason as to why a business wants to, buy another business and delist it off the market, and that is they believe they're going to make money. They believe that that stock, that investment is so overlooked, it is so mispriced, that if they buy that business in its entirety, own it in its entirety, they're going to make much more money by having it than having it listed and having the sharing the profits with other minority shareholders. So just some perspective in terms of what we've seen in the market. The second point here is that within a cheap market, there's a lot of stock picking opportunities. And as I've mentioned earlier, our buy lists are long. As a matter of fact, there are many SA equities today that are not in our client portfolios because our budget is saturated, which we think will deliver much better returns than SA bonds and cash on a 5-year view. Also, these stock picking opportunities is this main reason behind the exceptional performance and alpha which we've delivered at Coronation over the last 3 or so years. It is not because we're working harder all of a sudden. It is not because we've become smarter all of a sudden. It is a direct result of the value and sort of mispricing of stocks on the JSE. Now, there are many examples of businesses that have added significant value to our portfolios over the last couple of years. But the best examples I could find are those listed on the screen under point number 2, where these South African businesses have always sat with very valuable offshore assets within their portfolios. But because the market is so depressed, because market participants are neglecting South Africa and they don't do the work, these underlying businesses are undervalued. And as a result of that, management teams have decided to take action and to unbundle these businesses and give it back to shareholders. we have been beneficiaries and significant beneficiaries of the three on the screen as well as others. Montauk is a renewable energy company which spun out of HCI. It is today listed on the NASDAQ, up 165% over 2 years. Textainer, the global containing business, spun out of Trencor, listed in the US today. Our clients have owned about 30% of Altron for the last couple of years. They've always had Bytes, which is their software business in the UK, in that portfolio. In December this year, management team decided to unbundle that and to list it on the FTSE, up spectacularly from those levels. Just, in recent weeks, we saw RMI announcing the fact that they are unbundling their holding in Discovery as well as Momentum Metropolitan, a significant immediate value add for shareholders overnight. The third point is that there are some great opportunities in domestic, or call it South African Inc. stocks at this point in time. What is happening is that management teams are using this crisis, certain management teams, to strengthen their positions. And we've seen this throughout every single crisis which we've lived through over the last 28 years at Coronation, is that after every single crisis, there's a line in the sand drawn between those businesses that are investing in their businesses, investing in their competitive positions, as opposed to those that are just cutting costs and sweating assets. And we can already see many businesses exiting this crisis in a much stronger competitive position relative to those that are going to be left behind. So sure, many investments in South Africa will turn out to be poor, but also bear in mind 60 million people still live here. They still need to go to a bank. They still need life insurance, and they still need to go to a retailer, so to speak. And we are seeking those businesses that are digitizing their organizations, using this crisis to strengthen as opposed to weaken their businesses. And there are numerous examples that we can find in the market today. The fourth point, and this is a very important point, is that there are so many very attractively priced global businesses on the JSE. Our calculations today suggest that very close to 70% of the JSE as it stands today is not beholden to the South African political or economic situation, as these businesses operate in offshore jurisdictions, and as a result of that earn their profits and revenues in offshore quasi-hard currency jurisdictions as well. We look across the spectrum of businesses on the JSE. Naspers process, we think it is extremely attractive. Quilter, British American Tobacco, Anglo American, Glencore, Aspen, Anheuser-Busch, Bidcorp, the list goes on. These are all global businesses which happen to be listed here and which we think will turn out to be exceptional will deliver exceptional returns for investors on a forward-looking basis. And if I fail to convince you in the prior 4 points, please all just bear in mind number 5 there. One just needs to remember that only equities have the ability to compound your wealth for many years to come. As an equity investor, you've got this magic formula behind you, which is compounding, which is only true for equities and no other listed traditional asset class that you can find. Anywhere in the world, it doesn't matter where you are, who you are, whatever the case is, over any meaningful investment period, equities decimate any other asset class. And that is a very, very important point to consider. And we all have that to our advantage as investors, and especially as long-term investors. Yet during periods of turmoil, periods of crisis, we fly and flock towards safety of cash, bonds, etc. And what is very perverse about that outcome is that nowhere in any failed state has cash or bonds been the answer. As a matter of fact, should South Africa, become a failed state, should this whole place, blow out, you are going to be much more hurt in cash and bonds than what you will be in equities. And use Zimbabwe or Venezuela as a case study. This year alone, the Zimbabwean stock exchange is up 340%, whilst inflation and interest rates are running at 50 and 60%. The Venezuelan stock exchange was up to the tune of thousands of percent when they went through their crisis, whereas bondholders and cash holders lost very close to 90% plus of their global wealth due to the eroding effects of currency debasement and then the ensuing inflation that takes hold once governments bail out. So please, just remember that you've got this massive benefit as an equity investor. And if one is prepared to take the long view, you will be rewarded over time, and no other asset class will come close to delivering the returns that equities will over any meaningful investment period. The big pushback we get today from our investors is the fact that because you're a big stakeholder in the South African economy, because you're a South African asset manager, you always have a good story to spin, around South Africa and, endorsing South African assets, come hell or high water. What I want to tell you today is that is certainly not the case. These are 2 slides unchanged from our January roadshows in 2013 and 2015, where we for the first time communicated to investors that they should expect significantly lower returns from SA equities for the foreseeable future. In 2013, our big 5 views were that domestic assets were expensive. Global assets still offer exceptional value, and importantly, the deteriorating fundamentals in South Africa do matter, and they will catch up with investors at some point in time. We all know that 2013 was still a sort of, knockout year for SA equities. 2014, the market still went up. It was still a fairly decent year. And in 2015, we revisited that message because we now felt that this bull market in South Africa has become very long in the tooth. And we communicated the fact that the future won't always be like this. You're buying South African equities on high ratings as well as record high earnings bases. And by the way, foreigners can't get enough of the South African stock exchange. And spelling it out for investors and things that we have now consumed our daily lives, like expensive and unreliable power, the fact that our labor market is globally uncompetitive, et cetera, et cetera. These were well flagged 5, 6, 7 years ago. And this is the reason why at that point in time, we held the lowest exposure to SA equities in our balance funds ever. As a matter of fact, in 2015 and 13, our exposure to SA equities in our Balance Plus fund was about 30%. Today, that number is higher than 50%. It is a marked increase in the exposure to that portfolio. And here you can see that exact equation. So the blue in the shaded area is South African equities in 2013, 14, 15. You can see less than 30% of the fund was exposed, with the overwhelming majority of the exposure where we could in yellow, which was offshore equities at that point in time. Today, we've increased our exposure to SA equities since basically to levels which is the highest it's been since the GFC in 2008, 2009. And again, mentioning what we are seeing and witnessing from a valuation perspective. This is the chart on the bottom, shows the upside to fair value, which we calculate for the equities in the South African market, which we own across our house view portfolios. Because our process and philosophy has been so consistent over time, obviously the results on the slide is also very consistent and very comparable to one another. Due to the fact that SA equities came off this massive 10-year bull market in 2013, 14, 15, we saw very close to 0% upside in the market at that point in time, which is indicated by this red circle on the graph. Move forward 5 years, the market has underperformed, disappointed, etc., and we are close to finding 60% upside in South African equities today. Another reason why, for the first time in 10 years, we are today overweight South African equities on the back of what has become very, very attractive valuations. What is also interesting, and I think I made this point quite clear in the 5 points which I wanted to address, but it is one thing to say the market is cheap, but that cheapness or opportunities is confined to a particular sector of the market. Where we are really fortunate today in the JSE is that we are finding value across the breadth of the market, whether it is in resources, Anglo-American, some of the platinum players, Northern and Impala, Glencore, especially the new energy play, coal, as well as the gold shares, which I alluded to earlier. Global stocks, which happen to be listed on the JSE, BTI, Textainer, Aspen, Prosus, Squalter, Bitcorp, Anheuser-Busch, the list goes on, as well as domestic shares, where our exposures are typically concentrated in banks, insurers, and FMCG retailers. As I've mentioned earlier, we still remain conservative and sort of concerned about the consumer, but importantly, there are going to be winners coming out of this COVID crisis, and it's our job to identify them.
Sorry, Bernard, if I can quickly just cut in there, we quite over time.
Oh,
if
yes,
you
I'm
wouldn't
only noticing that
mind
now.
running through the last slides,
Mm.
so we can still have a bit of a question or network session after this, please.
Sure, sorry, apologize. So
No
just
stress,
very
thank
briefly,
you.
I've got 2 or 3 slides to go to. And I mean, if you then look at the Coronation Top 20 Fund, which has had a phenomenal, 20 years, quite frankly, you can see the themes coming across the top holdings. You know, those global stocks, which happen to be listed here, the SA specific businesses, which we think will be long-term winners, as well as the commodity plays. A well-diversified quality portfolio trading on a forward PE ratio of 9 times. That contrasts to sort of the S&P 500 at north of 21, 22 times. A dividend yield higher than cash, which we think grows at levels at least in line with inflation for the foreseeable future, with upside to 60%. We think investors really need to consider, their capital allocation and asset allocation decisions in their portfolios. And then, just looking at performance, even the 3-year number, the 5-year numbers, which have always been the sort of worry for investors, are now changing rapidly. Over the last 3 years, this fund is up about 50%. Okay, and again, who would have thought? And I think relative to the average fund out there, significant value add. I mean, the average equity fund, yes, has struggled. But if you select a good active manager with a long-term track record, you can get 50, 60% better outcomes over a very short period of time. And that is exactly what this fund has delivered you. So in conclusion, just to wrap up and to sort of, put our estimates to this conversation we just had, we update this, once or twice annually, and a lot of work goes into this quantitative sort of, output level. And as I said earlier, the price that you pay on today, it's the biggest determinant of your future return outcome. Local equity is attractively priced. Global equity is richly valued. As a result of that, one needs to temper your expectations. And as I said earlier, we would not be surprised if local equity outperforms global equities on a 10-year view. And that is certainly our expectation. And our current asset allocation, our portfolios certainly reflect that view. So I want to thank you for your time. Apologies for going over time. I did start a couple of minutes late as well. But yeah, if there are any questions, anything that you maybe wanted to bounce off me, please feel free to ask them. I'll go through the chat box now as well and have a discussion with you guys.
Fantastic. Thank you, Bernard. Bertie, I think you're on the agenda just to round off and facilitate our networking session. Are you able to unmute and jump in with us there, Bertie?
Yes, good morning to everyone. I hope you guys can hear me.
Yes, got you loud and clear.
Yes,
Thanks, Bertie.
hi,
Good morning.
Hi, Bertie.
Nice to see a lot of familiar faces. Guys, I just want to say at the end of the session, it was great having you on. Yes, it was a fantastic presentation, Bernard. I could listen to you for another hour and more, and I'm certain you could keep us busy for half a day if it comes to the push. But we do have to apologize that we did go over time in terms of our planned timing. So if there's any questions, I would like to handle that from a networking perspective. Otherwise, I think also considering everyone's time, that maybe we should call it a day and just make certain that at our next session we make allowance for Q&A and networking as one exercise. At least put 15 minutes aside for that. But your comments would be appreciated. If not now, later on. I know it was said before by Tim, some recommendations and spot on. We're going to mold this session to be as great as this one. The value add. Thanks again, Bernard. It's fantastic.
Yes.
So I'll conclude with that. Thank you very much.
Thanks, everyone. I really appreciate it. I'll also dial off now. Really appreciate your time. What I will do is I'll share the slides with Edward and Tim, and they are more than happy I'm more than happy for them to distribute it to you and to the rest of the team as well. Thanks for your time and thanks for listening. Appreciate it.
Brilliant. Thanks, guys. I've already shared one post on LinkedIn, and perhaps and I'll add this into the email campaign that goes out this afternoon with the link to this video recording, that we could spark more conversation on the LinkedIn page. I don't know how everyone feels about that, but that also then opens up the broader community And again, with the vision of SAIFAA 5000, getting a lot of input there when it's fresh in our memories. Are you guys happy with that, Johann and the Exco?
Thank you, Tim. I think continuing on LinkedIn is a great idea. Can I add one last item that we didn't get to? And that is that our renewals are going out for membership fees. And we also announcing today that we also have a monthly debit order system available as from December.
Fantastic. Johann, maybe you and I can just chat about the wording for that, and we can include it in the email campaign that goes out later.
Yes.
So we can continue just to build on the vision from Derek and the early founders, and on the value that we've already established in this morning's session.
Correct. Tim, thank you very much for hosting all of this, and thank you very much from my side, from the Exco side, to everyone that contributed today.
Fantastic. I'm going to close the session. Look out for an email, guys. Have a wonderful day. Bye-bye.
Thanks very much. Cheers. Bye.